Imagine for a second that the walls around you, literally the roof over your head right now, could suddenly start cutting you a monthly paycheck. Sounds pretty incredible, right? Especially if you're approaching retirement and feeling house rich but cash poor. You've poured decades of your hard-earned money into this mortgage, and now your house is finally paying you back. But as with literally any complex financial product, the reality is a whole lot more complicated than the slick sales pitch.
So, welcome to The Explainer. Today, we're cutting right through the marketing jargon of reverse mortgages to see if this promise of easy cash actually holds up. We're sticking strictly to the facts and the actual mechanics of these loans to give you a crystal clear, completely unbiased look at what really happens when you try to turn your home equity into income.
Here's our roadmap for today. Section 1. Tapping your home's equity. Section 2. How reverse mortgages work. Section 3. The hidden costs and risks. And finally, Section 4. Exploring your alternatives. Let's get into it.
Section 1. Tapping your home's equity and the promise of immediate relief.
Okay, so are you house rich but cash poor? For homeowners who might not have a ton of other assets, suddenly needing to pay for massive medical bills, or really just trying to supplement daily retirement income, that's a huge problem. You might be sitting inside a house worth hundreds of thousands of dollars, but, well, you can't exactly buy groceries with drywall. That trapped equity is exactly the problem reverse mortgages are designed to solve.
Now, what's really fascinating here is how this completely flips the script on a traditional loan. With a standard mortgage, you borrow a lump sum and immediately start paying the bank back every single month. A reverse mortgage? It does the exact opposite. The bank pays you by drawing on your equity. And the crazy part is, that income doesn't need to be paid back until a specific trigger happens, like leaving the home, selling it, or passing away. It's essentially an immediate cash injection with a seriously delayed repayment.
Section 2. How reverse mortgages work and the actual mechanics of the loan. First things first, there is a hard boundary here, 62. You've got to be at least 62 years old to qualify for the most common type of reverse mortgage, which is called a home equity conversion mortgage, or HEC. These are government insured through the Federal Housing Administration. This age limit is an absolute strict constraint for HECMs, so this is a product explicitly targeted at retirees and older homeowners. And the sheer scale of what's possible is honestly pretty staggering. $1,149,825. That is the current maximum limit for a HECM loan. Now, to be clear, you aren't automatically going to get that much. The actual cash you can access depends on a few major factors, like your age, the age of any co-borrowers, your home's appraised value, and current interest rates. But that number really shows you just how much trapped wealth the government is willing to let you unlock.
You essentially have three main routes you can take. We just covered the HECM, right? The government-insured standard. But you also have proprietary reverse mortgages. These are private loans that can actually offer even higher borrowing limits, though they usually come strapped with higher interest rates, and they sometimes ditch those strict age restrictions. And finally, there are single-purpose reverse mortgages. These are offered by state and local municipalities for one specific designated use. Think paying off property taxes or funding a critical home repair.
If you get approved, they don't just hand you a giant check. Well, unless you want them to. You can actually structure your payouts in 3 distinct ways. You could take it all as a single lump sum. You could set it up as a flexible line of credit so you only draw what you need when you need it. Or you can get regular monthly payments for a set time period, or even for as long as you live in the home. It is incredibly customizable to whatever your cash flow needs happen to be.
Section 3. The hidden costs and risks. In other words, the catch.
Because here's the reality. The bill always comes due. Eventually, when one of those triggers happens, you move out, you sell, or you pass away, the loan must be completely paid in full. And it is not just the money you borrowed. You have to settle the principal balance, all that compounded interest, and the accrued fees. Since you haven't been making monthly payments all those years, that total can be absolutely massive. In most cases, the only realistic way to satisfy that huge debt is with the proceeds from selling the home itself.
You really need to carefully consider how these severe risks are going to impact not just you, but your entire family. These loans are notorious for their extremely high fees. Plus, if you fail to meet their strict terms, you're looking at a very real risk of foreclosure. They can also mess with your eligibility for certain government benefits. And looking down the road, it creates massive headaches for your heirs. We're talking dramatically reduced inheritances, or even the very real threat of evicting family members who still live in the house if they aren't listed as co-borrowers. That immediate relief definitely comes at a steep future cost.
Section 4. Exploring your alternatives and your escape hatches.
Okay, so let's say you go through the whole process and actually sign the closing papers. You do still have a brief, federally protected escape hatch. It's called the right of rescission. This gives you exactly 3 days after the loan closes to just cancel the whole thing, walk away entirely without paying a single financial penalty. It's essentially a built-in cooling-off period to make sure you haven't made a massive mistake.
And if you do decide to walk away, either before you sign or during those 3 days, you are not out of options. You can always look into alternative financial routes to get at that equity. Things like a standard home equity line of credit, a traditional home equity loan, or doing a cash-out refinance. Now, yes, those alternatives do require regular monthly payments, but they often let you avoid the super complex triggers and the messy inheritance complications of a reverse mortgage.
So, as we wrap this explainer up, I want to leave you with a pretty provocative question. Is your home equity actually worth the final cost? Look, a reverse mortgage is undeniably a powerful tool to tap into the wealth you've built over a lifetime without having to pack up your boxes and move. But it comes with high fees, incredibly strict rules, and serious disadvantages for your family's future wealth. You have to carefully weigh that awesome feeling of immediate financial relief against the long-term impact on your heirs. Review the facts, look at all your alternatives, and make the choice that truly fits your life. Thanks for joining me today, and keep learning.